I'm Anthony Smith with HFG Trust, and this is the Chart of the Week video. Hello and welcome to our weekly video. I couldn't help but notice that these videos have been getting progressively longer and longer over the past several weeks. Last week's video broke 7 minutes. Nobody wants to hear me talk that long, so I promise that this one and future versions will be the bite-sized videos that they were always intended to be. All right, the topic for this week is stock market valuations. Several weeks ago, if you'll recall, in our August 13th video, we highlighted stock market values based upon our preferred valuation metric, which is the price to book value ratio. This time, we'll focus on a very popular ratio, which is the price to earnings ratio, or PE ratio. So let's kick off this discussion with what I would consider a natural concern right now, which is that stocks have had an incredible run. Surely they're overvalued and are becoming more overvalued by the day. Okay, I think a case could be made for that, but for the purposes of this discussion, let's find a reasonable rebuttal to that position. And this is where the chart comes in. It shows two lines with different y-axes. The blue line with the left axis shows the S&P 500 index value from January 2020 to the present. And we can use that as a proxy for stock market prices. The white line with the right axis shows the PE ratio of the S&P 500 over that same time period. Now, this time frame captures the COVID-induced tailspin and then the subsequent recovery, which has the S&P 500, the blue line, trading at levels well above pre-COVID levels. But the PE ratio, the white line, hasn't exhibited the same up and to the right pattern that has so many of us concerned that stock markets are flying too close to the sun. Why is that? It's because the PE ratio in this case is the forward PE ratio. The price, the P, is today's price, but the earnings, or E, in this ratio refers to projected or estimated earnings over the next year. Stock markets are forward-looking. Prices today incorporate expectations for tomorrow. And these earnings estimates, the E, are continuously updated. So as we have exited the worst of the pandemic economically, earnings outlooks are becoming rosier. So the biggest takeaway from this chart is that stock valuations based upon the index's forward PE ratio are no higher than they were back in May of 2020. That's almost a year and a half ago, despite the remarkable run that we have seen in stock prices over that period. That's it for this week. We'll see you next week.